Hi, good day, and welcome to another edition of the BY Samo channel. And since it's an accounting class, as usual, we say welcome to the BY class. So, in today's edition or in today's class, we'll be looking at lesson 6, where we'll be talking about the double entry principle, the double entry principle, or the double entry bookkeeping. So, before it starts or we begin today's lesson, I would like you to take a moment to like, comment, share, and also subscribe to the channel. For today's objectives, we'll be looking at the definition and meaning of double entry bookkeeping. We will also tackle the rules for debit and credit. And then finally, we'll be looking at the double entry transactions or how to do the recordings for the double entry transactions. So stay tuned, get your books and notes ready, and let's get started on rewriting the stars. Okay, so definition and meaning of double entry principle. Now, when we come to the definition, we say the double entry bookkeeping is a system which involves recording each transaction twice. Just as the name sounds, the name says double entry. Double means two. So in this case, if we are entering a transaction double or we are entering a transaction in a double way, it means we are entering a transaction twice or we are recording it twice. So the double entry bookkeeping simply means recording transactions twice. Any transaction you see, you record it twice. That's the basic understanding of double entry bookkeeping or the double entry principle. Every transaction is recorded twice. So now let's look at what the principle says in details. The double entry principle states that every transaction affects two books. Every transaction affects two books. And what are these books? The one book is receiving and then the other is giving out. So, with regards to what the double entry principle is saying or is claiming, is that whenever you go to purchase an item or whenever you go to conduct or transact a business with someone, it has to be recorded twice because it is two parties involved. One party will be receiving something and then the other party will be giving out something. So that is a basic understanding of what the double entry principle is saying or is trying to claim. Let's look at what it further says. It says that we should debit the receiving book and then also credit the giving book. So because there are two parties involved where one is giving and one is receiving, what the principle is saying is that when we are trying to record this particular transaction within our books, we should debit the receiving book or debit the receiving party and credit the giving party. So in the nutshell, what this principle is trying to say is that every debit entry has a corresponding credit entry, and every credit entry has a corresponding debit entry. So, taking an example like you go to buy an item from a supplier. You go to buy an item from a supplier. When you go out there to go and purchase the item, you are going there with cash. It can be a check, it can be a cash. But in this example, let's focus on the cash. You are going to purchase the item with cash. So because you are going to purchase the item with cash, the person who is the supplier, who is the storekeeper or who is selling the item would have to record this particular transaction twice. Where the first part of the transaction is where the cash is coming, and then the second part is the commodity or the item which is going out of his or her company. So you stay tuned. Let's just continue and then look at details of it with examples. Like we'll take real-time transactions and then we'll do the recordings for them. So what the principle states basically for you to understand or for you to keep in your mind is that you are supposed to debit the receiving book and then credit the giving book. debits the receiving book, and credits the giving book, while every transaction is being recorded twice. Every transaction is being recorded twice. Good. So let's continue to um, our next objective for today, which is the rules for the debit and credit. So how we are going to tackle the debit and credit with real-time transactions. How we are going to tackle them. We will first look at the cash or bank account. The cash or bank account. So when you are doing your recordings and then you get a particular transaction, and when you look at the transaction, it has a cash account inside or a bank account inside, then we are going to do the recording by debiting all receipts. We will debit all receipts and we will credit all payments. If you've forgotten how we get the account, I would advise that you kindly visit lesson 5, which talks about the ledger account, the ledgers and accounts. So visit the lesson 5 to get more details on accounts. So in performing the double entry transactions or in recording double entry transactions, we first have to identify the accounts that are within the transaction. So when we identify the accounts within the transaction, the two accounts, basically there are two. For every transaction, there are two. So if we identify the two transactions within the account and we find out that, one of it or maybe both are falling within the range of cash and bank, or one of it has a cash account within it, then this is what we'll do. We'll look at the cash account within it to see whether it is a receipt or a payment we are making. If it is a receipt, that means we are receiving that money from someone. And if it is a payment, means we are giving out the money to someone. So if it is a receipt, that means we are receiving from someone. We will have to debit that particular account, which is the cash or the bank account. And if it is a payment we are making, we are going to credit the account. I hope this is very clear. And now we move on to personal accounts. When we look through the transaction and we realize that the account within it is a personal account, this is how we are going to treat the double entry. Now, if it is a personal account, we are going to debit the receiver and then credit the giver. If it is a personal account, we are going to debit the receiver and credit the giver. So the personal account basically talks about the individuals that accounts that belongs to individuals or companies or businesses. So something like Kofi's account, Alex account, Nevin's account, so and so's account, Ames account. Any account that belongs to an individual or an entity, we are going to debit the receiver and then credit the giver. So if in that particular transaction, let's say Chris was receiving an item or a commodity in that transaction, that means you are going to debit Chris's account. But if in that transaction, Chris was the one giving out the item, that means we will credit Chris' account. So basically, debit the person receiving and credit the person giving out. Now we go to the third part of the rules for debit and credit. And then the third part has to do with real accounts. Real accounts. So with regards to real accounts, when we are looking at the transaction and then we identify a real account inside, now this is what we will do. We will debit all incoming values of tangible items. Debit all incoming values of tangible items. The real account has to do with tangible assets, items that belongs to the company or items within the company that can be seen and touched. They are tangible. So any value that is coming in to the business, we are going to debit it. And any value that is going out of the business, we are going to credit it. In other words, When the value is coming to increase the assets we have in the company, we will debit it. But when the value is going to decrease the assets we have in the company, we will credit it. So the values coming in will be debited, values going out will be credited, or values increasing our assets will be debited, values decreasing our assets will be credited. I hope this is well understood. And then we'll take examples so that you get the clearer understanding, so don't worry. Then we come to the nominal account. And the nominal account has to do with expenses, the ones we can't see and touch, but then they are within the organization. So expenses or revenues, losses, what have you, those ones. So with regards to nominal account, when you look through the transaction and we identify a nominal account within it, this is how we treat the nominal account. We will debit all expenses, all losses, and costs of intangible nature. Anything that will cost our business, it is either going to cause us an expense, it's going to be a loss, or it's going to anything that would be of the negative side to the business, either an expense, a loss, or a cost, is going to be debited. When we say debited, it means we are recording it at the debit side of the T account. We are recording at the debit side of the T account. And when you hear me say debit entry means we are recording at the debit side or the left side of the T account. And when I say credit entry, it means we are recording at the credit side or the right side of the T account. So with nominal accounts, we are going to debit all expenses, losses, and costs of intangible nature, and we will credit all revenues, incomes, and gains for the account. When it's a nominal account and it is a revenue account or it's an income or a gain, we are going to credit it. But if it is an expense, loss, or cost, we are going to debit it. I hope this is well understood. So now let's start taking real-time transactions to look at how best we can do the recordings for them. Now let's look at the first transaction. And according to this transaction, it occurred on the 1st of February 2025. 1st of February 2025. And the transaction says started business with $2,000 cash. Started business with $2,000 cash. And back when we're looking at accounts in lecture 5 or lesson 5, we realize that whenever we mention started business, we are referring to something like capital. Started business, we are referring to something called capital because the owner is the one going to introduce that money. So if it's starting the business, it is the capital for the business. But look at this. They said started business with $2,000 cash. So in the first transaction, we'll be able to identify that there is a capital account. And what were we starting with? We were starting with cash. So that is the two items or the two accounts that we are finding within this particular transaction. We are finding this within the transaction. And whenever we hear capital means it's obviously the one given. The owner is now introducing that money within the organization. So it's obviously a credit entry. It is what a credit entry. So because it's a credit entry, we are going to draw our T account first. When you draw the T account, then on top of the T account, you indicate the account name. So this one is going to be the capital account. The capital account. And because the capital was given out or the capital was the one given, we are going to record it at the credit side. So it has a credit entry or the right side. So we indicate the year, we indicate the currency, which is the dollar, and then underneath that one, we come and write the date of the transaction. So 1st of February, then up here indicates the year, so 2025. So the corresponding transaction, which is the cash, will be recorded in the middle. So whenever we take the capital account, we know the money that came inside was cash. That is the corresponding account, was cash. And then we record the value under the currency sign. So 1st February, we got a cash of what? Or we invested a cash of $2,000. Now in the corresponding account, the rules says that when the cash is a receipt, that means cash is receiving. So our cash within the organization is receiving. So because it is receiving, it will be a debit entry or the left hand side of the T account. So we record it, we draw the T account, and then we indicate cash account. We indicate the name. We do the same year, the dollar sign, then we indicate the date, that is 1st of February 2005 or 2025, sorry. And then we indicate the corresponding account, which is capital account, and then we indicate the value. So you realize capital was recorded at the credit side, cash debit side. So it has balanced the side. Now let's look at the second transaction, which occurred on the 5th of February 2005. Here we bought goods $500 paying by check. We bought goods $500 paying by check. When we go out to buy something, it is purchases. When we go out to buy something, it is called purchases. So immediately we go out to buy the thing. When we do not indicate what we went to buy, we record it under purchases account. When we go out to go and buy something and we do not indicate the exact thing we went to buy, it is called the purchases. It is recorded in the purchases account. And then the means through which we purchased it is indicated here, check. And whenever we talk of check, it is bank. Whenever you make reference to check, it is recorded in the bank account. So we were paying by check. So if we are paying, that means the bank is doing what? It's making a payment. And we said payments are credited. That is why we have 5th of February purchases and then 500 at the credit side of the bank account. And then the purchases was recorded at the debit side. That means the purchases account, that is an expense to us. Because, or yes, it's an expense to us. We have gone out to go and purchase something. So it's an expense to us, and expenses are debited. So we have it at the debit side of the T account. Now we come to the third transaction, which occurred on the 10th of February 2025. We sold goods to Nevin. We sold goods to Nevin worth $1,500. We sold goods to Nevin worth $1,500. So in this case, we have sales account. Why are we saying we have sales account? Here too, we didn't indicate the actual thing we were selling. If the item that we were selling was indicated, that means we will record it in that particular item's account. But because the items were not indicated, but they just referred to it as goods, we are going to write the sales account. And then who were we selling to? We were selling to Nevin. So Nevin's account will also be created. So because we were selling out, that means our value is what? Or our item within the organization is decreasing. So if our items or our assets is decreasing, the rule says assets decreasing, we are going to credit it. Asset decreasing, we are going to credit it. And if it is a personal account and the person is receiving, we are debiting it. So Nevin's account is a personal account. So Nevin's account will be debited with sales of $1,500. And then sales account will be credited with a corresponding of Nevin 1,500 account. So Nevin's account is debited with sales 1,500 and sales account is credited with Nevin 1,500. I hope this is well understood. Let's take another example, another set of example, or the continuation of the transactions. So on the 15th of February 2025, we withdrew $350 from bank for personal use. 350 from bank for personal use. Immediately personal use comes in, it means it is going out of the business completely. So when it is going out of the business completely, it is a drawings we are making because it is reducing the capital we invested earlier. So drawings account to be credited. And then we were withdrawing the money from bank. So bank account will also what be created. So bank was the one giving to us because it was from bank. So if bank is the one giving or doing the payment, it is credited. So 15th February. Oh, we made a mistake with the month. It's supposed to be February. So 15th February, and then the corresponding is a drawing, so $350. And then drawings account to be debited with bank of $350. Now in the second transaction, or the fifth transaction, which occurred on the 20th of February 2025, we paid electricity bill $900 cash. We paid electricity bill $900 cash. So you see here we have an expense account. It's an expenditure because electricity is a, they said bill, so it's an expenditure. Electricity account to be created. The expenditure account to be created. So you see here we indicated what we were paying for. That is the electricity bill. So the electricity account to be created. And because it's an expenditure, the rule says expenses should be debited. So we are debiting it. Expenses is debited. So we are debiting it. Here too, we made a mistake with the month. So kindly do the correction when you are following closely. So electricity account is debited, and then the cash account, because we are paying with cash, it's a payment. So cash is credited. Cash is credited. Right hand side, left hand side. Kindly take notes of what we are doing very closely. Now on the 22nd of February 2025, we bought motor vehicle on credit. We bought motor vehicle on credit from Samsung. We bought motor vehicle on credit from Samsung. So you see here we've indicated what we went to buy. So because we've indicated what we went to buy, we would create the account of what we went to buy. That is motor vehicle. So motor vehicle account is created. Now here we were not, we bought it but we didn't pay. So we bought on credit. So we have to indicate where we went to buy from, so that when we get the money, we can go and pay to the person we bought from. And so here it's indicated that we bought from Samsung. Since Samsung is going to be a personal account, we are going to look at it from the angle of who is receiving and who is giving. So here they say from Samsung, that means Samsung is giving. So if Samsung is giving, the rule says credit his account. If Samsung is giving, the rule says what? Credit his account. So that is why we have motor vehicle Samsung's account recording the entry at the credit side. Credit side in reference to motor vehicle. That is 5,000. And then motor vehicle account will be debited with Samsung's reference as $5,000. I hope this is very well noted. From Samsung, so because it's from Samsung, it is credited, and then motor vehicle will be debited. I hope this is understood. Motor vehicle will be debited because it is an asset. It is increasing the assets we have. That means we are going to get an additional motor vehicle, or we are going to get a new motor vehicle within our organization. So if the asset is increasing, it is debited. That is why we have motor vehicle being debited $5,000. I hope this is understood. Let's look at the last set for the questions or the transactions for double entry. So we have 24th February 2025. 24th February 2025. Smith returned goods worth $200. Smith returned goods worth $200. So here, because Smith is the one returning the items, we will create Smith's account. Smith's account. And then because we are receiving the thing, they said he has returned. That means he came to buy something from us, and maybe there was a problem with the item, so he was returning to us. Yes, he was returning the goods to us. So if he's returning the goods to us, and we've already recorded it when we sold it to him, so because of that, we have to create a new account called the returns inwards. Returns inwards simply means he's returning items to us. So Smith's account, because he was bringing out or giving out the items, he will be credited $200. And then because we were receiving the items, we will be debited $200. I hope this is well understood. Smith returned goods to us, so meaning Smith is the one giving out. And then because he's returning something that was already sold, we are going to create a returns inwards account, indicating that something we've sold out has come back to us again. On the 26th of February, next transaction, return goods 800 to Karen. Return goods 800 to Karen. Now we are returning the goods to Karen, meaning we went to purchase something from Karen, and maybe when we brought the things, there were problems with some of them. So we returned it back to her. That is Karen. We return it back to her. So because we are returning back, we are going to return outwards. So we are recording it in the returns outwards account. And because we are this time and we are the one giving out the item, we are going to credit our account. And Karen is going to receive the item back. So personal account, if the person is receiving, we debit. So Karen's account will be debited in reference of returns outwards. 800, 800. I hope this is well understood. And then the final transaction for the day or for today's lesson, received a loan from SSB Limited. Received a loan from SSB Limited cash. So we are receiving a loan from, the very moment the word from appears, that means it is coming, the person after the from is the one given. So SSB Limited is giving us a loan. And how was he giving us the loan? He was giving us a loan through cash. So cash account will be created, and then the loan account, that is SSB's account, will be created. So cash is the one receiving because here SSB is given. So if SSB is given, so loan SSB Limited account will be created in reference to cash because he was giving us the loan in the form of cash. That is $1,200. And then here the cash was receiving within our bank, within our company, the cash was receiving, so it is a receipt. So we reference it to SSB on the debit side, 1,200. So here cash was receiving, so it is debited, and SSB was given, so it is credited. I hope the debits and credits were understood. So in all transactions, first identify the accounts involved, and when you identify the account involved, you look at it to see whether it is a personal account. If it's a personal account and the person is receiving, you debit it. If it's given, you credit it. If it is an expense account, you debit it. If it's a revenue, you credit it. If it's going to increase our assets, you debit. If it's going to decrease our assets, you credit. I hope all this understood. And if it's a cash or bank account and it is a payment, you credit. If it is a receipt, you debit. Now, these trial questions are for you to try on your own. And what does this trial question say? It says, Chris started business on 1st January 2007 with capital of 160,000 euros. So just that first line should indicate or should tell you there is a capital account there. The first line alone should tell you there is a capital account there at the top, because he was introducing a new money into the business. And then the continuing says, the following transactions took place during the month of January. So on 1st January, purchases of furniture by cash, 24,000 euros. On 2nd, purchases of stationery by cash, 2,000 euros. On 3rd, bought goods on credit from J. Thomas, 40,000 euros. And then on the 5th, cash sales of 60,000 euros. On the 18th, goods sold to Brenda and Co. on credit, 2,000 euros. Paid advertising expenses by cash, 2,000 euros. Paid Thomas 35,000 euros cash. And then paid salaries on the 31st by cash, 6,000 euros. So these are the transactions made or reserved for you. You have to first identify the accounts involved, and then you look at it, whether it's an expense, revenue, then you follow the rules, then you record the transactions as it's supposed to be recorded. All the best with this trial question. And finally, we've come to the end of the lesson for today. So don't forget to like, comment, share, and then also do all to subscribe to the channel for more. And then, yes, that is all for today. So have a great day and stay blessed. Bye for now.